Okay, so now let's do the same sort of thing for Sahali's balance sheets here. Okay, so what I've got are the past 2 years balance sheets. And over here, for each of the 2 years, I've either got percent of sales or formula. So let me put that in here, sales or formula. Okay, so no special formula for accounts receivable, no special formula for inventory, no special formula for other current assets. So I just get the percent of sales for each of these. And 20x0 is easier for me to point out to you because the sales in that year I've rounded off to an even 100 million. Okay, so the 25% of sales here is equal to 25 over 100, and that's equal to AR at EOP Y0 divided by sales in Y0. All right, so that's how I've gotten all of these percent of sales. And same thing here when the sales in this year were about 90.1 million. So the cash level I'm not going to worry about because this is her big question. We're going to be solving for that going forward, so I don't care about that. And for PPE, that's part of our PPE roll forward equation. Accounts payable, no special accounting equation, no directive on accounts payable or accrued liabilities or other current assets. So I have my percent of sales for these guys here. And the debt here, we definitely do have something for debt. The company policy is to keep that D over D plus E constant. That's what they want to do going forward. So that'll be the company policy for that. And for equity, we're going to use our equity roll forward equation. So equity EOP equals E BOP plus net income plus PIC, which for us is going to be, as we know, 0 minus div. So this is pretty much how we're going to project things out on the balance sheet. Okay. And yeah, things to note here. So most of the things where we have no formula available, where we're measuring them going forward as percent of sales, you can see there it's not perfect, but even though sales have grown 10% in the past couple of years, these ratios are pretty constant. And what a lot of folks like Warren Buffett, value investors, would say is that this is the balance sheet that is needed to support a given level of sales. So the balance sheet looks like this. You need a balance sheet with AR equal to 25% of sales, inventory equal to 25% of sales to support any given level of sales. So, yep, anything we don't have a directive for on the balance sheet, we're going to project these forward as a constant percent of Y0 sales too. Okay. And the thing shown with gray on the right, we do have formulas or CFO policies for, and cash levels are, that's the big question, right? Cash level is the big question from the CFO. So we're not going to worry about the history of that. So let's think a little bit about the things we are projecting as percent of sales. Okay, the things that we're projecting as percent of sales, as we've seen before, we're going to say account value and the balance sheet for year one, which is always end of year one. It's going to be estimated sales in year one times that accounts percent of year zero sales. And I've done this example for us on the previous page. Going forward, the accounts receivable at end of year one will be our estimated sales in year one times 25%. And again, where did we get that 25% from? We got it right here. It was accounts receivable was 25% of sales in the most recent year, and we're assuming it's going to be 25% of sales in the next year, year one, that we're projecting for. So let's just think about things that we have a formula for. Once again, just sort of beat this together. So cash, again, we're going to solve for that, so not to worry. But in general, if we weren't solving for cash, it would be set probably at some percent of TTM sales. PPE is part of our PPE CapEx depreciation roll forward. So we have our equation for that, our net PPE, we'll use that. And for debt, we have our company policy here that debt to cap is equal to 20%. And if you do a little bit of algebra on this, you can confirm this for yourself, that the debt in every year going forward is going to be 20% of the equity divided by 80%. So that's our formula for debt. And how are we going to get equity? We always have two things in accounting that help us with equity. One is our roll forward, equity end of period equals beginning of period plus net income plus paid in capital minus dividends. And we also know that equity at all times under all circumstances equals assets minus liabilities. And we're going to use this. We will use 22J to help us in this case. Okay, that's our equity roll forward equation that we talked about. And this is just something that you should know. Sahali has no goodwill, but it's a good thing to know about. And remember, goodwill is what an entity pays for a company that it purchases over market value of equity. And GAAP has a couple rules now about how to handle this, but the one that we're most interested in, the most common one, is to say that goodwill is constant forever unless the company has a reason to believe it's been impaired. And that's going to be our assumption, that if we see goodwill on a balance sheet, we're going to say it's constant unless we're told that it's compromised. All right, so let's look at our historical roll forward equations now. Again, we have equity beginning of period plus net income minus dividends plus paid in capital equals equity end of period. So you can see equity end of period for the most recently reported year was equal to 80, and that's equal to 76.85. The equity at the beginning of the period plus the net income of 7.74, okay, minus 0. Remember, they haven't been issuing dividends, okay, and minus 4.58. That, again, remember, they had a little share buyback. They had an investor who wanted to leave. They bought some shares back. That was fine. So that's what we've got there. Now, the other thing that we're going to need is part of the taken from the cash flow statement and other stuff, which gives us our PPE roll forward equation. PPE net beginning of period minus the amount of where plus the amount we've added to PPE is PPE net end of period. So you can see my end of period for a year ago becomes my beginning of period for the most recent year. My depreciation, remember 10-year average life of all their PPE, so it'll be 10% of beginning of year net PPE, and their target for PPE at the end of the year to make sure they have enough to keep up with all the new machines they need for baking and mixing and packaging and all that stuff is they want at the end of the year their net PPE to be equal to 100% of TTM sales. So in this case with Sahali, they know this, they know where they want to be, they know what depreciation is, and they solve for the amount of CapEx they have to spend to make this true, to hit their target for net PPE at the end of the year. So they can solve for their CapEx, and they're going to do that using the roll forward equation. So the net PPE at the beginning of the year, let me just put the whole thing here, 18.18 is equal to our 100 minus 90.91 and plus 9.09. And that gives us our 18.18, solving that for CapEx.